Next up, I have the distinct pleasure to introduce Trent Mcdonald, CFO of HEXO Corp. We've got some great updates for you here. Okay. Trent, I'm going to let you take it away, man.
Thank you so much. Thank you. How is everybody? I have to apologize up front. They told me that the only thing I have to do out here is to look good. So seriously apologize for that. I don't know, you know, small crowd here, but I don't know if anybody knows who HEXO is. Raise your hand if you do. Okay, so a few people. So HEXO, not sure if you know, but HEXO is actually the largest licensed producer in Canada by market share. So bigger than Tilray, bigger than Canopy, bigger than Aurora. We have the most recreational cannabis sales in Canada. And people don't, I think people may discount Canada as a not so important to market, but it is actually one of the more mature, certainly the most mature country in terms of a legal cannabis market in the world. And it is right now streaming towards about $4.5 billion of retail sales in the current year. That is you know, a large chunk of retail sales in the recreational space. And it's projected to grow from there up to about $8 billion over the next 3 to 5 years and somewhat beyond. So it's about, you know, if you look at it relative to the US, it's about 1/10. Right now, Canada is the size of California in terms of the market. So it's an important market to be able to do well in. And it gives you that, if you can do well and prove out your model, then clearly you can get the trust from investors and others to come and say that you can probably duplicate that kind of an effort here in the United States, if you, of course, have the right strategy. So I want to give you a little rundown of our company. Currently, we're the largest Canadian licensed producer. Like I said, we have been extremely active in M&A over the last 6 months. We've purchased 3 separate LPs, and in doing so have propelled ourselves again to #1 market share. But more importantly, it's not about just being in #1 market share. We are #1 or 2 in every single province, and one of the #1 or 2 in every single product category that matters. And so that's what it's done for us, this M&A. It was very, very strategic in how we went to market to look for potential acquisitions. So with us, you know, there's a lot of things about us that people don't realize. Again, we have this wonderful center of excellence in Belleville, Ontario. That is a world-class CPG production facility where we do almost all of our production, where we have some of the lowest COGS in Canada and quite frankly in the entire market. Because of the nature of how we operate, we have a very low depreciable capital base, even though we have over, you know, 2 million square feet of grow space between all of our facilities. And then the Belleville Center of Excellence itself, we still have an extremely low depreciable capital base. And if you know anything about accounting, and I'm not sure anybody does, but that depreciable capital base gets depreciated into your COGS. And if you have a large depreciable capital base, which we do not, others may have billions, in fact they do, it's very hard to obtain good margins on a consistent basis, especially in a price competitive category like a 28-gram bag or a 1-ounce bag of cannabis, which is becoming a bit commoditized. And so you have to be able to compete on margin. We are very, very good at that. We have also taken some of the best and brightest in our ReadyCan, which is the most recognized brand in Canada, which we now own. And we're taking that into brand new markets that they hadn't been in before, such as Quebec, which is the 2nd largest cannabis market in Canada behind Ontario. We have currently, I don't know if anybody knows, but we actually have this wonderful joint venture partnership with Molson Coors. And we produce beverages, well, some of the best beverages you'll ever drink, quite frankly. And you know, where you see the success of that in Canada, we've now been able to duplicate that success in Colorado, albeit not in THC. It's CBD hemp in Colorado versus THC in Canada. But we've had similar success, and we've been able to announce recently that we have now expanded and are expanding into 14 additional states with Trust Beverage in those products. So it's a big congratulations to everybody involved there, because it's been quite an undertaking. I can tell you, everyone looked at Colorado and said, geez, beverage is only 1% of category, that's likely what it's going to be in Canada. The difference is in that mature market at the time where it was only 1%, they didn't have good products. It tasted, if you had a beverage, it tasted like a beverage that was very literally made by a cannabis company. That's what it tasted like. No other way to explain it. But now we have great beverages that taste like they're really good beverages to have on any occasion. We have them for all occasions, and all of a sudden we have 52% market share in Canada, and the category has grown to 2.5 times the size it was in Colorado, and it's continuing to grow. We also have a lot of things that we're going to do in the United States in terms of the legal, what is now legal in the United States for 70% of citizens. 70% of citizens in the United States have access to legal cannabis. We cannot wait until federal legalization comes in so that we can then try to crack into that market. So we're looking at creative ways right now on how we can do that. And I can talk about that in a couple seconds. So here are some of the brands that we have. And not to say that we're going to bring any or all of these brands to the United States. We're still going through what a brand strategy would look like in the event that we're able to figure out how to proliferate what we offer as a products company in the United States. But these are some of the brands that we offer throughout Canada and in many different verticals. As a company, just talking a little bit about who we are. Again, our goal is to be not just, we're now #1 market share. We're the ones with, we have a very clear path to EPS over the next several quarters. But where we see ourselves really down the road is a top 3 global cannabis company, which means that we have to have, a very strong strategy, very well thought out and articulated strategy for all involved in internal to us and our stakeholders, and then be able to execute on that strategy. And there are several pillars to that strategy. First, we have to be consumer-centric. And that is something that people, it's very difficult to label that and to execute on that particular strategy in a brand new immature industry where a consumer goes into a retail environment and they're faced with hundreds of brands, all the kinds of products in the world that they've not been accustomed to, even coming out of the illegal channel where they were accustomed more to flower than they were to vapes and hash and concentrates. So it's been an educational journey for us and others as we propel ourselves to become more and more consumer centric. So we have to have purposeful brands and really bring the store to life, and we're doing a lot of things around that. ESG is a big thing for us. You may have seen that about ourselves, and I'm going to talk about that. We also have operational excellence and impactful innovation. We're #1, 2, or 3 in every single category, and we're continuously innovating within those categories and proliferating our particular products within those categories. So we're constantly innovating. We have a lot of money being spent on R&D this year, in addition to our genetic program. So ESG, look, this is something that's extremely important to us and extremely important to the consumer, quite frankly. If you're not in ESG today, which a lot of our competitors are not, unfortunately, because we actually want them to be, then over time it's not going to resonate. Your products need to resonate, and this is one way of doing it. And so that's a tertiary benefit where you actually just care about the environment, quite frankly. But we have now offset 100% of the carbon footprint of our operations and all of our employees. And we've done that by partnering with some really, really great partners. The Great Bear Rainforest, for example, but Dimapack, one of our biggest partners in plastics, and going to Plastic Bank to offset. And we're not going to stop there. We've been doing a lot of things around lighting, packaging. We were the first to go to pouch pack and eliminate all container packaging. And so we've done a lot of things that have been very innovative and first movers within the market, to try to prove a point that sustainability can still lead to profitability, which it has. The thing about HEXO, however, if you are a trader, an investor or investment fund, is that there's a tremendous value opportunity. If you look at our market disconnect, our market share is 15.5% on a TTM basis, and we've been increasing the gap between ourselves and second, third over the last 2-3 month cycles. Yet our stock is woefully undervalued comparative. And not just here on a straight market cap perspective, but we're trading at 1/3 the actual multiple of sales to enterprise value as some of our biggest competitors. And so there is a very big disconnect. And there's a lot of reasons for that, but none of them have to do with our actual operational performance. More to do with the M&A, the cost of that M&A, the idea that we've diluted, which we have, let's be honest, over the last 6 months to pay for those M&A and the integration that comes as a result of that M&A. And so there's a lot of money being spent to do that. And because we've also have opportunities we want to take advantage of here in the United States, and that requires capital. But look, the truth is, as much as that's thrown at us, dilution, we've actually diluted over time, although currently, yes, over time, the least. We have deployed $2.1 billion of capital since our inception, $2.1 billion. If you take that into account into 10 basis points of market share in recreational space in Canada, that's about $14 million per 10 basis points. So not only have we only raised $2 million in total capital from all purposes, we only spent $14 million per 10 basis points of market share. Compare that to some of our competitors like Tilray and Aurora, who are both about $6 billion and range from $180 million per 10 basis points down to $46 million per 10 basis points of market share. And you can see who's been making best use. And then Canopy is over $10 billion of capital deployed. And that translates to about $85 million per 10 basis points of actual market share. So not only have we diluted the least, we've made the best use of those investor funds over time. And it just so happens that we've done a lot currently, so it's top of mind. So look, we need to unlock our value. We know that. And so we're doing a lot of things. I think the first thing we can say is that results will speak for themselves. In July, and it fell on deaf ears because it's in between cycles, quarterly reports, and analysts have not updated what that means for their models as of yet. But if you go back to mid-July, we released the pro forma showing what we would have been with ReadyCan for the trailing 12 months, with Cannabis, with 48 North, and ourselves, what that looked like. Well, what that looked like is that we were the only LP to actually have income from operations. Now, that's not adjusted EBITDA. Adjusted EBITDA is everyone uses it. I still advocate for it, but that's not a GAAP measure. Income from operations is a GAAP measure. We're the only ones that would have had income from operations over the trailing 12 months. So, I mean, and you're talking about the others who are 150, 200, a $1.1 billion loss on an income from operations from one of the larger LPs. So we actually have fundamentally great results. As you see these getting consolidated into the actual reported results, we have Cannabis for a couple months of Q4. We have Cannabis, ReadyCan, and 48 North for a couple months of Q1. But once you get to Q2 and you see all of that integration and the synergies that come from that integration, and you put all three of us together, we're hoping, without guiding, that it's going to be a very, very powerful set of results that I don't think people are anticipating at this point. They're certainly not valuing it into our share price. Also, we have a comprehensive IR plan, part of which is me standing here talking to you good folks, and we're looking at U.S. expansion. So we're looking at U.S. expansion, again, in the legal channel as a products company, not as an MSO, as a products company. We're looking at optionality to buy into an operational company at some point when it becomes legal, but lending in our IP and our expertise and our products into that company that we would have optionality to purchase down the road, and then looking at how you unlock the value, perhaps through a, if you're thinking about unlocking value, you could talk about how others list on the OTC. It's a source of capital, in addition to investors being able to see the true underlying results and the value of those results reflected in market cap, which of course then gets reflected in ours because of the optionality to buy it. And so, there's all different things we're looking at and different markets we're looking at going into with different products. Nothing to announce just yet, but I can tell you we're putting a lot of resources on it, and we're hoping to announce something in the near future. So look, that's my shtick on HEXO. Happy to take any questions you might have. I know that was very quick, but here I am.
Wonderful job. Everyone give it up for Trent Mcdonald, CFO of HEXO. If you guys have any questions, make your way to the mic in the center of the room. I'm going to get us started with a couple minutes left here. Trent, congrats, man. I mean, you guys achieved your goal of becoming the carbon neutral, right? So you addressed it a little bit in your slide, but I'd love to know, what do you think the industry needs, right, to do in order to follow in your footsteps and jump on board in what is ideally a very important initiative?
Look, it's massively important for a lot of different things. But look, you know, in the end, if you're wondering about what makes a consumer tick, especially in very liberal, more socialistic environments like Canada, people care about that. You know, the number one, I don't know if people know this, but the number one, I should say the number one growing fast food chain in Canada is A&W. And it costs more to buy a burger there than McDonald's by country mile, just a fast food chain. They are known as the organic, you know, eco-friendly alternative, and people are willing to pay more for it. It's a great example. And so what it does, it helps your margins, it gets people involved, people want to buy your products, they seek them out. And that's a tertiary benefit, but that's what people have to think about as not just LPs, MSOs, you know, it actually does provide you an opportunity to sell your product for a little more, get a little more out of it, and do something friendly for the environment. You know, start with what we did. You know, offset. You know, that's just money. It's cost. And yes, nobody wants to be throwing around money, but what a great way to spend a little bit of money, offset. You're going to make it up on margin and sales in the long run. Maybe not first month or second month or even second, third quarter, but it's going to happen if you do the right things you need to do around marketing and brand management. And that's what we're doing. Obviously, we have a very large plan around this, but that's where you have to start, and then start with packaging, and then go to lighting, go to, you know, or organic growth methods. There's a lot of things that we can and should be doing as an industry.
That makes a lot of sense. We probably have time for one more, and in case, just in case, Zacks recently upgraded their rating on HEXO with positive sentiment. It seems like they're leaning towards an upward trend in earnings right now. What you can tell us about company performance and where you're going next, obviously.
Yeah, look, we typically stay away from guidance. I think it's gotten a lot of us in trouble over the first couple of years of this industry. But what I can tell you is this: if you go back to that mid-July release that we did that showed the pro forma and the actual results, the audit results of ReadyCan, and you look at where we did on a trailing 12-month basis, you know, because it's all publicly available information. We did $276 million in revenue. I can tell you that we have followed by 17 analysts, and we have 14 reports, and I think the consensus estimate on us is around 190 or 200. So that's saying that not only are we not going to hit the 276 from trailing 12 month, we're going to shrink instead of grow. So I just don't think people realize just how powerful and transformative this M&A was. And we have put a world-class team around the integration planning, and now we're into integration execution stage. I'm talking world-class team. And so we plan on getting every single synergy and keeping every one of those sales and growing them. That's our goal, you know, and we'll see how it works out.
Wonderful. Any more questions for Trent Mcdonald? All right, sir. Thank you so much for being here. We really appreciate it.
Thank you.
All right. Take care.